After years of uncertainty, a major breakthrough has happened in crypto regulation. The Digital Asset Market Clarity Act is on the verge of becoming law, following a Senate compromise in March 2026-1. This is huge. For nearly a decade, the crypto industry has been stuck in a regulatory gray area, with the SEC and CFTC fighting over who regulates what. This regulation by enforcement approach led to lawsuits and a lot of confusion for both investors and developers. But that's about to change. The Clarity Act passed the House with a decisive 294-134 bipartisan vote too. A Senate compromise was announced on March 20th, 2026, clearing the way for this landmark legislation 3. This means we're finally getting a comprehensive federal framework for digital assets. A critical piece of the Clarity Act is a joint interpretation issued by the SEC and CFTC on March 17, 2026. This 68-page document, SEC Release Number 3499847, formally classifies digital assets 5. Why does this matter? Because this classification isn't just a fancy name. It dictates everything from who regulates an asset to your tax reporting obligations. The framework divides digital assets mainly into digital commodities and investment contract assets. This clarifies which agency has jurisdiction. The CFTC will now have exclusive oversight over digital commodity spot markets. This is a game changer for many prominent cryptocurrencies. So, what are these classifications? According to the joint release, 16 major crypto assets are initially classified as digital commodities 6. This includes big names like Bitcoin, and if you hold these, they're now officially digital commodities. All other tokens, especially ones from initial coin offerings or ICOs, are presumed to be investment contract assets under SEC oversight. They'll stay that way until they can prove otherwise. This table shows the breakdown. Digital commodities are regulated by the CFTC and taxed as property, with sales and swaps treated as capital gains or losses. Investment contract assets are under the SEC and also taxed as property, but with stricter disclosure rules. One of the most innovative parts of the Clarity Act is how a token can transition from an SEC-regulated investment contract asset to a CFTC-regulated digital commodity. This acknowledges that projects can start centralized but become decentralized over time. This transition relies on what's called the mature blockchain standard. For a network to be considered decentralized enough, it needs to pass a 3-part test. First, no single person or group can control more than 20% of the asset's supply, or voting power 7. Second, the asset has to be actively traded on at least 3 registered exchanges. And third, the project must maintain a minimum market capitalization of $1 billion over a trailing 12-month period 8. This means new projects start under SEC rules, protecting investors, but they have a clear path to reclassification if they achieve true decentralization. While crypto is still taxed as property, the Clarity Act completely changes how your taxes are reported and enforced. Say goodbye to guesswork. The biggest change for you is the full activation of IRS Form 1090-90A10. As of January 1st, 2026, all digital asset brokers, like Kraken, issue this form for the 2025 tax year and beyond 9. This form will report your gross proceeds, cost basis, and holding periods directly to you and the IRS for every disposition. This has major consequences. First, the IRS will now have broker-reported data to cross-reference with your tax return. Any differences between your exchange's 1099-DA and your Form 894911 could trigger audits. Second, the 1099-D only covers centralized platforms. It won't capture your D trades, LP transactions, or NFT mints. This creates a huge data gap. Let's talk about that D data gap. Imagine you bought 2 ETH for $3,000 each on. We'll report this. Then you send that ETH to your MetaMask wallet and use it to provide liquidity on a decentralized exchange. The IRS sees the withdrawal from on your 1099-DA, but they have no visibility into your subsequent D transactions. This is where things get tricky. Your exchange-reported cost basis on the 1099-D might also be wrong, especially if you transferred assets from other platforms or self-custody wallets. It's your responsibility to correct this on your tax return. This means you need to accurately track all your on-chain activity and reconcile it with what the centralized exchanges report. It's a complex task, but crucial for avoiding penalties. This is exactly where a comprehensive crypto tax platform becomes essential. Tools like dTax can import your 1099 data and connect to your self-custody wallets and D protocols. It automatically reconciles all your transactions, helping you bridge that D data gap. dTax supports 22 blockchains, including all the major EVM chains, Bitcoin, and it also handles 13 different cost basis methods, so you can choose the one that saves you the most money. The 1099-D, a reconciliation center, helps you match broker-reported data against your on-chain records and flag any discrepancies. Plus, the pre-audit sandbox scans for IRS audit risks before you file. Check out .com. It's open source and free to start. A key part of the March 2026 Senate compromise directly impacts D users and stablecoins. To protect traditional banks, the Clarity Act will reportedly bar yield payments on passive stablecoin balances held with regulated intermediaries. This means earning simple interest on C held on a centralized exchanges earn program might be restricted. However, the deal was carefully crafted to preserve innovation in D. It explicitly allows for rewards generated from active network participation. This is a crucial distinction. If you're actively providing liquidity, staking, or engaging in other complex D protocols, those rewards are generally considered active. So, while passive interest on stablecoins might be out, active D yield generation is still in play, but you need to understand the new rules. This is a common concern. If your exchange provides an incorrect 1099-DA, it's still your responsibility to report accurate information to the IRS on your Form 8949. You'll need to use the data from your own records, especially for assets transferred in or out of the exchange, or any D activity. This is why meticulous record-keeping and using a crypto tax software capable of handling both centralized and decentralized data is so important. You can't just rely on the exchange's numbers if they're wrong. You need to reconcile it yourself and make sure your tax return reflects the true picture of your capital gains and losses. The Clarity Act and the new 1099-D or reporting requirements apply to all digital assets, regardless of when you acquired them. So, if you've been holding Bitcoin since 2017, those holdings are now subject to the new classification as a digital commodity. When you eventually sell or dispose of them, your broker will issue a 1099-DA for that transaction. The key is that the reporting framework has changed, not necessarily the tax treatment of the assets themselves as property. However, if you're holding an ICO token from years ago, it will now be presumed an investment contract asset under SEC oversight until it meets the mature blockchain criteria. The Clarity Act marks a new era for crypto regulation and taxation. The IRS now has more visibility than ever before, thanks to the mandatory 1099-DA. Understanding the difference between digital commodities and investment contract assets is crucial for compliance. Don't get caught off guard by discrepancies or the D data gap. Accurate record keeping and leveraging robust crypto tax tools are essential. Stay informed, stay compliant, and protect your crypto investments. Thanks for watching, and I'll see you in the next one.